You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye. He's the chief investment strategist for Institutional Advisors. Welcome to the show, Bob.
Jim, it's good to be with you. Fascinating week in the market. And
what's been the big highlight?
Well, one was the Bank of Canada dropping its administered rate, which they've got some idea that lowering rates is a stimulus, and I don't know why they keep this idea going, because the Japanese central bank has been doing it since 1990 with very little positive result, except issuing legions and legions of bonds and talking up a theory and a practice that just doesn't work. So, hey, you had the Canadian dollar going down, it should be good for exports, but then the reason why the Canadian dollar is going down is because it's a commodity currency, and you've had a crash in crude oil and in copper prices, for example, not to overlook iron ore prices. So, and so this is going to help Canada by depreciating the dollar when it was already depreciating. It was just, unfortunately, a Keynesian knee-jerk to some perceived problem. And it really does underline that if you establish a central bank to provide extraordinary credit when the central bank deems it's needed, those guys are going to feel needed all of the time. And if they aren't trying to provide credit, who would need them? And this is the whole point. There is no need for a central bank. And the only thing they can do is depreciate currency. And this is why, using the U.S., which has had a longer central bank since opened the doors in January 1914, and I think the purchasing power of a dollar in 1914 is now down to about 3.5 cents. And one outfit is to blame for it, central banking. Bank of Canada started in 1934, so it hasn't had as long a history, but it's right in there and very good at depreciating currency. So it will do no good and it will do harm, because you've got people still on fixed income and trying to get by and lowering rates, as I say, a form of bureaucratic madness.
Well, central banks seem to be a fact of life. What can we do to work around it?
Well, they force everybody to being a speculator. You now have this artificially low interest rates, and people are desperate for income, so they're reaching out and buying horrible stuff, junk rated. And of course, if you take a look at countries in Spain where trading at 2% yield in Spain, for example, and you couldn't describe that as a AAA security. It's more towards junk. So and people are being forced to do this because a committee of the ideas always come from the academics, is that if you manipulate this, you can have a wonderful economy. And I'm saying it's going on for 100 years, and it is now. And the worse it's seen to work, or the less success seen in the practice, the harder they try. And now in Europe, of course, the big noise was where Draghi for the last 2 years has been talking up that they were going to buy bonds, and they finally were able to get the mechanism where they can start to buy bonds, and I don't know, 50 billion a month or something like that of whatever. So we'll see how much of the story about buying bonds, European bonds, was in the market, because you've got the German 10-year note is down to 0.38%. That's not, it's almost down to 0.25%. It's never happened in history before. You've got an uptrend going on in yields in Russia, of course, for a number of years, and it reached a maximum a month or so ago as crude was crashing and they were in desperate straits, but then it sort of settled down a bit. And then more recently you've had the Greek yield moving up on their political turmoil with an election and who knows, a new gang of socialists in and things like that. So certain issues in Europe are acting like junk bonds, which is the street is showing some sense there. But the future historians will look back on this period, and honestly, they would shake their heads and say that it was fanaticism, where the process that you're doing is not working, and yet they try twice as hard to make it work. So they think they're heroes and are going to save whatever they see that needs saving. But I think the main thing, Jim, is that they're really trying to prove that these theories about flooding markets with credit out of thin air work. And I think the public in the next few years will make the discovery that they don't work, and then will take steps to reduce the ability of these guys to experiment, maybe just put them back on the universities.
Well, isn't the premise of this theory you can spend your way out of debt?
Oh, yeah. I remember decades ago reading it, and back in the 1930s, the saying was that, oh, we drank a whole lot last night. I drank so much I drank myself sober. Oh, sure. Tell me that one. And then for the last 20 years ago, there's been a saying about when the Fed is the bartender, everybody drinks until they fall down. And this is what it's about. Because the central bank has absolutely no discipline whatsoever. The theories of interventionist economics does not have an ability of self-criticism, and that's why you've got this insanity going on. There's no checks and balances in it. And also, with the overall idea of government, where you have checks and balances with the judiciary and the legislative branch and the administrative branch, and then plus the media, there should be checks and balances all over the place. But the interventionists have captured the legislative system, the central banking system, the judiciary, everything. And it has no, I said it before, I'll say it again, no ability of self-criticism. But the only way to criticize it, of course, is to look at the history and see what the history is about. And I've often said that financial history is a due diligence on every grand scheme that has ever been floated in the financial markets. That would be by private people, and as well as every grand scheme floated by policymakers who are experimenting in their ideas. So, and it always turns bad at some point. But this is what we're looking at now here. We've got, a couple of weeks ago, we thought that the crash in crude oil could stabilize for a while, take a little pause. The numbers we were using, Jim, on crude oil were over the years of history of crude oil. It's best to look at some of these things adjusted relative to producer price index or relative to gold, and it gets a little more meaningful. So at any rate, it's been a very good crash, no matter how you measure it, in crude oil, and it has further to go, but in the meantime, we're going to get a pause. We have been on this pause for a while. The other one that we had a good target on was copper, and it came down to a level that would find stability, so we're going to find stability there. The grains, which had been acting well for a few months and showed up in the chart at the bottom, and then they became not terribly overdone, but it was a good rally. And then with the crash in crude oil, that set of commodities couldn't handle it and gave it up as well. We looked at a couple that we don't watch too regularly, and cotton is one. It's now down to new lows. And the other one would be lumber, which is packing it in the last while. So you've got weak commodities, and these are all global commodities, and it's saying that the world economic growth is not all that vibrant and could be slowing down. And we're also looking at the bonds, the lower grade bonds, junk and high yield. They had a good run last year right up until June, and we often look, if you've got a hot lower grade bond market going into June, you're going to get a reversal, which we did, and there are pretty good pressures on those bonds down until 4 or 5 weeks ago, and there's been some stability in there since. Then the long treasury bonds, we've liked those since January a year ago, and they've turned out to be absolutely stellar, way up there, and the last few weeks of move have been pretty exciting. So we've been talking about ending action for this hot, long bond market, and it looks like we're getting it. We've got the relative strength measure, the RSI, way up, exceptional. I maybe only been as high as this 3 times since the bull market for bonds started in 1981. And back then, we should remember that the long U.S. Treasury yield was up to 15%. Now it's 2%. Amazing stuff, Jim. So and so we're looking for a very good high for the bond future in here, very close to now. And then what were we going to get there? Because for the last few years, you've had this opposite motion between stocks. When they wanted to check back, they'd pop up the long bond and other way around. So if we're going to get a sell-off in long bonds, would that suggest that the hot money rolls over and boosts the stock market a little further? Well, it's possible. The other thing we've been watching is the opposite action for gold sector relative to the S&P. And there's a little opposite coming in. You got a day where the S&P's up, the gold stocks will be down, and then the other way around. But the sector is acting well. Going back to last August or so, we were looking for perhaps an important low for gold stocks towards the end of October. And it turns out to have been, by around the middle of November was the actual a good low there, and then it was tested further on in December. But to get us into the precious metal sector, we were looking for some constructive action, which would be that gold shares would start to outperform the price of bullion, and that worked out, and that made a nice couple of bottoms there and good performance. And then the other is for a rally in precious metals. You want to see silver beginning to outperform gold, and that has been working its way out. So we'll say that we've got a good intermediate bottom in on the gold sector, and the advice was to do some accumulation on the weaker days, and that sort of worked out. So we're up here now where maybe the gold sector could take a little pause. There's been some very good moves in it. And just a little pause there. We're looking for a reversal in the long Treasury bond, and that would go for Government of Canada as well. And the stock market, it could maybe look after itself here for the next number of weeks. Maybe stability, maybe some rallies in here. And you've got a curious thing going on with the senior stock index in Europe, the stocks, STOXX, where the central bank is really depreciating the euro very quickly. And of course, you do have, over a brief period of time, something called the intrinsic value of the stock market. So you push the purchasing power of the currency down and stock prices go up. It's automatic. It even happened in the Weimar inflation in 1922-23. There were 2 places that made you money or kept you breaking even against the currency depreciation. One was gold, and the other was German stocks. So that then works. So you have the value, the nominal value, or the intrinsic value of the stock market being priced up as the euro's priced down. So you'd think then, okay, the value of the intrinsic value of the U.S. stock market is not changing that much over day to day. So then if the U.S. dollar goes up, you would think the stock prices would go down. But no, what you have here is the international speculators looking at the rising U.S. dollar and saying, let's own things in U.S. dollars. So then they're bidding up the stock market. So it's been a good game, and I don't know how soon it may quit. So I think there's a bit of sunshine for the stock market. There's a bit of a correction for the gold sector, and a major decline ahead for long treasuries. And that's our wrap for this week.
And we'll be talking about a crack-up boom when we come back with Bob Hoye.
More and more people are looking to the internet. for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600.
Welcome back. We're speaking with market historian Bob Hoye. Our friend Bert in the Netherlands has a question for us. What's the probability of what they're calling a crack-up boom event? Maybe explain what that is.
Yeah, well, I had to look that one up. That's why we didn't answer it last week and save it up. Because I've heard the term around and I'm vaguely related it to von Mises with the Austrian school of economics, which in the first part of the 1900s really did make an effort to understand the credit cycle and did a pretty good handle on it. And then they actually have this crack-up boom concept, which I think more relates to being in Germany in 1922-23 during the Weimar inflation, where the currency was printed and distributed around in wheelbarrows, and of course asset prices went up, and that was your crack-up boom. And then once they decided to stop the printing presses, then it all crashed. So then if you then look at the senior economy and senior currency in Europe, you can go back to the 1600s when Netherlands was the commercial and financial center of the world, and they were their guilder was gold-backed, and sure there was the tulip bubbles in 1673, but that was largely a credit market bubble, not based on currency depreciation. And then by the 1700s, you were into England, where then it was becoming the commercial and financial center of the world. And even though the South Sea bubble of 1720 was amazingly reckless, and government was a strong protector or participant in it, you had the first stock bubble way up, and then crash way down. And then that's been the pattern ever since in the senior currency and the senior economy. So then you had the bubble of 1772, then another one 1825, then 1873, 1929, and then 2007. They all have the same characteristics. So you can say 300 years, there never has been a crack-up bubble in the senior currency. Sure, you had a crack-up bubble in Germany in 1922, but that was not the senior currency, and Germany at that time was a minor financial world and not much of a credit market, so that's how they could do the printing press. So the Misesian idea of a crack-up bubble, I think, is theoretical rather than practicable, because if one was going to happen, it would have shown up in the senior economy at any time over the last 300 years. Instead, you get a classic bubble, and where you've got, financial mania going on, and then you have the change in the yield curve and change in credit spreads, and then 6 months later the stock market expires. So, nope, I think it's a good question, Bert, and I think it's more of a figment of the imagination of Austrian economists than reality.
Well, thanks for answering that question for us, Bob.
Always glad where we can find the answers.
Bob, thanks a lot for chatting with us.
Very good.
My guest has been market historian Bob Hoye. He's the chief investment strategist for Institutional Advisors. Their website, institutionaladvisors.com. You're listening to HowStreet.com radio. Find us on Twitter at Talk Digital Net. Our YouTube channel is Talk Digital Network. Comments or questions for the show can be sent to info@HowStreet.com. I'm Jim Goddard.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.